Hi, Peter Rose, Longwood Currency Trading. Hey, before I get into my video, I want to apologize. Number one, for the clarity. It's a little, possibly is a little low. I haven't looked at the footage yet to tell, but I'm down, as I explained at the beginning of the video, I'm down at a 400 setting on my camera from 15 or 1600 ISO from the other videos that I've done. But other than that, there's all these diagrams that I'm putting up in this. It's just a critical video. I'm not used to reading scripts and talking off, trying to do overlays on top of the stuff. So this is a little rough video. I apologize for it. But listen, the information is critical that I cover on this stuff. Please watch the thing all the way to the end and then make up your mind as to how you should view your way of calculating your rates of return and how you look at what other people tell you that they're making for their rates of return. This is just really tough stuff, and I hope you enjoy the video. If you do, give it a comment. If you don't like it, click the little I don't like so I know not to do this shit again, okay? And subscribe to my channel. I usually don't ask people to do that, but you know what? I'm just starting out with this channel. I got 32 videos or something like that. I'm looking for my 10th subscriber here. Life is good. I'm having a lot of fun. I just like to share it with a lot of people. I hope you enjoy it. Thanks. Hi, Peter Rose, Longwood Currency Trading. Important topic that I want to talk to you about today, and that's rates of return on your currency trading. I'm experimenting a little bit here with my camera. I had my ISO setting way up, which is more for nighttime stuff, and my wife, who is a professional photographer, said, well, hey, you probably don't want that. Why don't you go down to 100 or 200 ISO? And so I'm down at 400 now, and I have a suspicion this is going to be a little dark, but it doesn't make any difference because I'm not a filmmaker. I'm a currency trader in real estate and stuff. So the important thing is rates of return. I got my coffee. Let's get on to it. And the reason that I want to talk about rates of return and why it's such a critical issue is that knowing what your real trading rate of return is gives you a mathematical view of your trading efficiency. That's really why you're interested in whether you made 3% a month or 8% a month, because it gives you a mathematical view into the efficiency of your trading. When we're calculating or talking about rates of return, we can calculate them either based on compounding our money or whether it's a simple return. Now, when I calculate my trading profits and how I trade is through simple returns. I don't do compounding. There are a lot of reasons for that. I do a whole course on that, but those are the two ways. Give you an example that maybe is more familiar to you is that of real estate. Let's say you go in and you purchase a property for $100,000 and you put $10,000 down. You wait 2 years and you sell the property for $110,000. So now you'd say, well, geez, the property value went up $10,000 a year. It went up $10,000. Property value went up $10,000, $5,000 a year. So that's 5% a year, right? On that. Now I put $10,000 down on my investment, and so I made 100% return on my investment. So when people ask you, what did you make on your real estate? You don't say, well, I made 10% because the property went from $100,000 to $110,000. You take the amount of money that you actually put into the investment, which was $10,000, and in 2 years, you made $10,000 on that $10,000. So you made 100% return over the period of the investment, 50% return a year. So that's the difference between compounding and a simple return. Oh, but whoa, wait a minute now. We said that the property appreciated in value 5% a year. Appreciated 5% the first year for $5,000, and then the next year, to cap off the $5,000 $5,000 of the other part of the $10,000 was $5,000. But that's not exactly the case, because the hard asset itself, the real estate, didn't appreciate $5,000 the first year and then $5,000 the second year. That would be a simple return, but the real estate compounded. The compounding rate of the real estate, it turns out, is 4.88% a year, because what happened was that the first year that in order to get to that $10,000 appreciation in 2 years, it can't appreciate at 5% a year, because that would be more than $10,000 at the end of the 2 years. But if you compound the first years, if the building appreciated at 4.88% the first year, and then it compounded at 4.88% the next year, the building would have gone from 100,000 to 110,000. So the compounding is a little bit different. And I have some examples I'm going to be putting up on the screen here later to show you just exactly what that's all about. So I guess the point of this is that though the underlying asset compounded at a 4.88% value, my investment of $10,000 didn't compound. It had a simple return. It went from $10,000 to $20,000, and you can't apportion that off and say, well, I'm going to take my investment out at this point, and it's appreciated so much. It's the underlying asset that's compounding, but my investment is not compounding. It's a simple return. So I put in $10,000, and in 2 years I pull out $20,000 because I get my 10% back, and then the 10% of the building appreciated. So I get 100%, and I can divide that rationally by 2 and say that money appreciated in a simple return basis. Well, you can get really complex and you can map the compounding, but we're trying to keep stuff simple. Okay. So what does this mean for your actual trading itself? You can calculate returns based on in your trading. I did 3 scenarios where I took a currency pair that I put I had different levels of banking, and I looked at what would that return be if I just compounded on the way up, but then had a certain number, 6 numbers of set pip value losses in a row, but didn't compound downward. In other words, reducing the amount of my risk as each failure went forward. The second example is I did that. I compounded on the way up and I reverse compounded on the way down. And the third example was how I do things in a simple return basis. I just took 5 pips each time I had a profit, and then I took 8 pips as a loss. So you're seeing the screen now of this matrix of calculations. If you look at the top right diagram, that's the one where we're compounding only on the rise of property, and the second diagram is the one where you compound going up and reverse compound going down, and then you are going, next diagram, which is the, sorry about that. The next diagram here is the compounding only going up, and you see that when you compound only going up, but you don't change your leverage or the risk on the way down in the losing trades, you end up with $9,876 in the of value of the $10,000 let's say that you had put into the trade, which is your margin and your runway and all that. So it's your bank, your $10,000 bank. Here's the second example, and you can see here that by compounding going up and then reverse compounding and reducing your risk on the way down during the losing trades, you end up with a balance of $10,953.38. So you end up with considerably bit more. Now, if we go to the third example, you see that if I just take that 0.5% win or whatever per trade, and then I pull off an 8 pip loss, then I end up with $10,200. So that doesn't really beat. We'll go back to the main screen that we had before with the three in comparison. You can see that the compounding one way doesn't do very good when you don't reduce your risk, which I didn't do when I first had my first major real account. Yeah, you lose a lot of money really, really quickly. Compounding going both ways gives a $10,953 left in your bank, even after those 6 losses. And in the third one, there's a $10,200 bank. So although you could say, well, it's not that much less by doing the static returns, it's a $700 difference, and $700 against a $10,000 bank account is enormous. It's just huge, and so you just can't really consider that. All these slides, by the way, and a much more detailed and probably more coherent presentation, are on my blog site at longwoodcurrencytrading.com, and it's the blog concerning returns. Obviously, it has the same name as this video. Let's go on to the next slide that I have. What's the best rate of return based on? Well, we know that compounding will give you the best returns as long as you do it both ways over simple returns. The question is, what value do you use to calculate your return against? And I've highlighted here that there's 5 possibilities. You have your total account size, your full lot based on best practices amount. You have the funds available in your account. You have your margin only that you're trading, and funds available above margin. So let's take a look at each one of those. Here's your total account size. So let's say you've got a total account size of $30,000 and you make a $1,000 gain on your account. Well, the return on that is pretty simple. You made 3.33% for the month, 40% annualized. But the question is, what if I had $1 million in my account and made that $1,000 because I only traded, let's say, $10,000 of it? My monthly return would be 0.1%, annualized 1.2%. So would that be reflective of my trading? No. So I don't think you can take your total account size and balance that as the counterweight to the amount of money that you return. Now, hedge funds and banks and all that stuff, they have to do that because you're putting your money into the big pool and they want to know how well the fund did overall. As traders, we're not so much interested in what our fund did. We're interested in what our rate of return when we do make a trade is. That's the difference. So if you get down and you look at the full lot best practices, which means that if I'm trading a full lot, I have to have $10,000 bank in that account. So if I'm trading one mini lot, I need $1,000 in my account. And so if I'm trading 3 minis, I need $3,000. It's simple. So let's return to that calculation. I've got $10,000 in my account, and I trade one full lot. I make $1,000. Now I make 10% for the month. Well, remember when we used our full account size of $30,000 last time, I made 3.33%. So I'm a friggin' hero now, since I'm only using this best practices $10,000 balanced against the $1,000 that I made. I made $10,000 for the month. I've improved my trading results by 67%, but I didn't do a thing different. But there's some issues with that. Let's go to the next slide. What if I trade with just $8,000 because I don't have $10,000 in my account, but I make the same $1,000? Well, my return on the $8,000, then if I win $1,000, is 12.5% for the month, 150% annualized. And I got even better bragging rights then, but it gets even better than that. Let's go to the next slide. When you made that trade, did you need $1,000 to do that trade? No, all you really needed was just enough to put the position on. Your margin requirement, let's say, is $5,000, just for discussion purposes. So that leaves you $1,000 of trading money. So now you're balancing the $5,000 in your that's part of the margin, which is the only amount that you have to put up. Well, you might have to put up $5,001 in order to put your trade on. But if that's all you use with the margin, and you balance that on the $1,000 gain that you made because you got lucky and it hit on that first trade, you made 20% for the month. But it gets better than that. Let's say that you need just a little bit more money than the $5,000 of margin to make the trade. So the $5,000 is kind of static. You kind of sort of just need that to sit at the table, but you're not really spending that. You're only spending the amount above that. So let's say that you've got $8,000 in your account. You take the $5,000 margin off, and so $3,000 above that is what you actually are putting at risk for your trade. So you don't need to consider the margin at all. So you could then divide $3,000 of that remaining $8,000 into the $1,000, and you'd have 33% return for the month. You could go so far as even saying, well, I'm just going to have a $6,000 account, and now I've got $1,000 that I'm trading, so now I make 100% for the month. So it just gets just crazy, 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 crazy. Let's go back to that whole topic of what we're talking about here. What are we trying to accomplish in our trading? We're trying to determine the efficiency of our trading. So we're looking at this position return analysis slide in our trading. So look, there's 3 transactions that are made. The first transaction, we put one lot on, and we used the best practices amount of $10,000. We did another buy transaction, put another $10,000 on, and so we've got $20,000 of investment in it. We make a PL of $350 on that trade, and so we get a 1.75% return against that trade based on the $20,000 of best practices that we use. That's the method that I use, and I think it's easier to calculate that way. It's not, you're not messing with somebody's, well, I only got $8,000, so I made more than you did. Well, you didn't make more than I did. You made more on a percentage return, but how do you balance the differential in your returns? Are you really going to listen to somebody that says, look, I make 40% a month return on my risk? Well, no, because you're risking $1,000 and you made $1,000, and it doesn't make any sense that because you're trading short stack that you should be bragging that you made more money. You didn't, or that you were a better trader. I think you have to have some standard that you go by in order to judge this stuff. So the point, I guess, that I'm trying to make is I need another sip of coffee. I have to apologize for all the diagrams and stuff. I hate it when people do that. And that's why I don't do it very often, and I probably won't do this again. Because you're probably not watching the video right now. You probably dropped out a long time ago. And that would be unfortunate for those that did, because it's very important for you as an individual trader in order to identify clearly how you're going to judge yourself and your trading plan. You know, you develop a trading plan based on a trading methodology. You put those two things together into some kind of a system or whatever you want to call it, and then you make your trades. How do you determine the efficiency of that methodology? You can't just say, well, you know, I started out with $10,000 in my account, and sometimes I'd make $100, or sometimes I'd only risk $500 of the 1,000 or the 10,000. Sometimes I'd add a little bit more in there to buy a mini lot, and you have to have some kind of a system that manages that. And I wrote a computer program that does this from a margin standpoint. It just adds up all of the I can trade minis, I can trade half lots mixed with full lots. I can do all that stuff because all I'm doing is taking the actual money that is part of that trade based on a best practices amount, and then going through and doing my division against whatever profit or loss that I had. And that gives me, I think, a better sense of how my trading is going. So I become very jaundiced when I hear that somebody made, oh, we're making hundreds of pips a day. Really? I don't know. And I saw some fool on a video the other day saying, oh, you only have to make 5% on your account a day for 16 days a month, and you'll go from I think it was $1,000 you started with to 1.2 million. It's just stupid. It's stupid. The guy made a lot of money. He's a very successful forex trader, but he does not know anything about rates of return or risk. First of all, you're not going to make 5% a day. You're lucky to make 5% a month. If you're doing that, you're a hero. Look, 5% a month is 60% return a year. That's incredible. Where are you going to get that kind of return? And he's wanting you to do that 5% a day, 16 days a month for 10 months? Really? It's just not going to happen. 5% a day on a $1,000 mini lot is 50 pips. Bear that in mind now. So he's saying it's 50 pips. And he's saying, oh, look how easy this is. All you got to do is to figure out how to do this 5%. You see how bulletproof my system is. And people make it so hard. It is hard, asshole. And just because you got lucky and made a lot of money, or you have a lot of money, which in turn enables you to make a lot of money, is of no benefit to the rest of the folks that are struggling with trying to develop a system, and they only have maybe $10,000 or $15,000 in their trading account, or $3,000, which is probably the average retail trader's account, splattered all over the average. Splattered all over the number of retail traders that there are. And we all know that 90% of retail traders lose 90% of their money in 90 days. So, yeah, maybe the average of all the retail traders is 3,000, but of the retail traders that are serious and that are out there trying to make things happen, you're working with accounts between $10,000 and $30,000, most likely. And so it would be nice if you could make 50 pips a day. But if you've done any kind of trading, if you've traded for more than 15 minutes, you know that making 50 pips a day is really tough to do. So you got to be very careful about not only who you listen to and who you believe and who you want to listen to learn from, but also how are you then going to evaluate what you're doing? Are you going to feel bad when you do your trading and you're making 5 pips a day, and that only, I mean, you've got a $10,000 account, and so you're making you're making against a full lot, you're making $50 a day, and you're saying, I'm not going to be able to replace my income at $50 a day on 5 pips, making $50. Well, no. But if you had a $100,000 account, you'd be making $500 a day. That's $100,000 a year. If you could do that. And let's say you just trade 3 or 4 days a week on a $100,000 account, you can still make $30,000, $40,000 on that. It's on 5 pips a day. And you get some asshole telling you that you got to make 50 pips a day or you got to make 20 pips a day. Making those numbers is really, really difficult. And I think that's why a lot of beginner traders fail, because they see all these guys talking about we made hundreds of pips. We made 60 pips a day, getting by on 20 pips a day. Well, just try making 20 pips a day. It's not quite that easy. You look at the charts and calculate, watch the little squiggly line go up, and then it retraces. Are you going to have the grapes to stay in that trade? It'll go up 10 or 15 pips, and then it'll come down 5 or 8, and then it'll go up 8 pips, and it'll come down 5 or 8, and then it'll go up 20 pips, and then it'll come down. Well, where are you going to catch that? Where are you going to be? Are you going to be out on the daily chart? Are you going to put a 50 pip risk to try to make 100 pips? Or are you going to make a 25 pip risk to try to make 50 pips? And if you lose 6 times in a row, 6 times 25, figure that out against your $10,000 that you're trading. Are you really going to be able to trade like that? I mean, I just don't. We got to sit down and got to really think about this stuff. You may disagree with me doing my trading on a simple return basis, but you know what? When I look at that chart, I know exactly what that pip value is worth. I know what my loss value is. I know exactly what percent of my account that I'm trading. It's 10,000, it's 20,000, it's 1,000, it's 100,000, it's whatever that is. It's static against that amount. I'm not cluttering my brain up with trying to figure out what my returns are based on these varying compounding amounts. Okay, I put $10,000 up my first trade and I won $22.50. So my next trade's going to have $10,022.50, and I'm going to have a full lot and 1/16 of a mini lot. If you can do that, you're smarter than I am. And there's a lot of people that are smarter than I am. I play poker. I'm pretty good. I'm okay, but there's a lot of people that are a lot better. They have systems of tells and all the other stuff that they go by, and I don't know how to do that. I do what I'm good at, and so I do that in my trading. And I don't think there's many people out there in the average retail arena that has certain skills that maybe some of these guys are doing this outstanding trading. Maybe they got lucky, they're trading at 200 to 1 leverage. They got lucky with 6 trades in a row and they took their $10,000 account to $250,000. I'm not impressed. Trading is trading, and it's difficult, just like driving a car. You don't just get in the car and drive and get from here to a 20 mile away destination and then say, well, I know how to drive a car. Oh, and not only that, not only did I survive not knowing any of the rules of the road or the dangers of potholes and trains crossing in front of me, I'm not knowing any of that stuff, but now I'm going to go out and I'm going to get into, I'm going to take my car and I'm going to go into the racetrack and I'm going to do drag racing or stock car racing. I mean, these people are just crazy. Some of them get really, really lucky. We call that the gladiator effect. You start with 100 gladiators, 50 of them are going to die. That leaves you 50. Another 50% are going to die. All right, so now you're down to 12 gladiators. So 6 of them are going to die, and you get 6 left. Well, one guy's going to get left. Now, he could be really, 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 really good, and he could really have beaten all of the competitors that he's had. But what about the guy who was really, really good, but he was unlucky at the time when some dumbass stabbed him in the throat? So it's random. It's called the gladiator effect. So you get one guy that ends up at the end of that. Maybe he really is that good, or maybe something happened that he got lucky so many times in a row and he is where he is. Man, you've got to really consider very smartly what someone tells you their results are, and you have to be even more smart about how you evaluate what you're doing. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.